What's going on, everyone? It's time for another mortgage rate update because the Federal Reserve's making moves. The 10-year Treasury is not working the way it's supposed to. So there's a lot of things happening right now that on the surface make it look like rates should be getting better when the reality is they're kind of getting worse. So I'm going to jump in. I'm going to show you a couple of things that I'm keeping an eye on that I think are important for what's to come. Now, before I get into any of that, remember, if you're buying a home, don't worry too much about the interest rate because none of us can control it. Interest rates will do what they do. So if you buy today and rates go up after you own your home, how do you feel? You're very glad you have the interest rate you have. If rates go down, you're not stuck with what you have, you just refinance. So there's always a solution. There's a mortgage rate, an interest rate is a means to an end. So that being said, let's jump into it. I'll show you what I'm looking at because things are not working the way they normally do. Okay, so instead of starting off today looking at mortgage bonds trading, we're gonna start off with the 10-year US Treasury because I saw a lot of videos this weekend that said the 10-year Treasury is moving down and that means mortgage rates will improve. So if we look here, November 24th, 29th, 30th, this is the week, right? This is Friday and then this is today. As the 10-year Treasury goes down, mortgage rates typically follow suit. It's not a perfect science. It doesn't always work that way, and this is one of those moments in time where it is not working that way. So what you'll see is today we saw an increase. So you would think based on today that must mean that, shoot, mortgage rates hit a low point, same low we would have had back here in September. So we're back to the same levels we would have been in September, right? And now we're starting to move off of that. Well, if we jump over and look at mortgage bonds, totally different chart. It should be inverse. But what we've seen is November 10th, fairly bad day in the market. And then you'll see we're getting worse. And then this is right when, what's it called? Omicron hit, or whatever the new virus variant is, hit, and the stock market freaked out the day after Thanksgiving. Since then, we've been really, really flat. But it's trending a little bit more for the worse. Like, I like that it's flat. That's a kind of a leveling off sign. I like that we have some normalcy. But the problem is that the mortgage bonds are not doing what the 10-year is doing. So on the surface, if you're watching the 10-year Treasury, because I always say the best gauge you have to understand where mortgage rates are going up or down is the 10-year Treasury. It's not working the way it's supposed to right now because mortgage bonds are not doing what they normally do. Now let's look at something else. So if we go back further, I want to show you something I was looking at before. So kind of basic rule of technical trading is peaks and valleys. So if I start here, I have a peak. Come on, let me draw a line. Peak down to a valley. So that means rates got worse, came back up, rates got better, came back down, rates got worse, came back up, a little bit of recovery, came back down, a little bit of recovery. And this right here was an important day. I was really hoping that back in the beginning of November, we would see something because, look, when your valley is lower, this valley is lower than the previous, this valley is lower than the previous. That means we're trending for the worse. You have the same thing with the peaks. This peak is lower than the previous. What I was hoping for here is that this peak would be higher than the last one, but it wasn't. They hit basically the exact same levels. So ideally, if we would have broken through here, potentially we would have seen better interest rates, but that did not happen. We saw rates yet again get worse, and guess what? This valley is lower than this valley. So all that being said, it's been a good run. We've got the lowest rates in history for a very, very long time, and we're staying there. I think, right now, for the most part, you'll probably see a 30-year fix in the very low threes, maybe some hovering in that 299, 2875 range, depending on the circumstances. But rates are still ridiculously low. January of 2020, before COVID hit and went bananas, mortgage rate for a 30-year fix was like 3.875. And I remember telling people these are the lowest rates in history. We're never going to see better than this. And the only thing that made it get lower than that is this hopefully once in a lifetime pandemic. Now let me go a little bit further back because I think some of the things we're seeing right now tie into where we were right before COVID. All right, so if I come back to here, this right here is when the market went absolutely haywire and the Federal Reserve had to step in to stabilize mortgage bonds and treasuries. So right here is where the Federal Reserve started buying mortgage bonds. So I'm just going to zoom in at this section here. Okay, so we kind of have this new normal over here, and look at what happens if you draw a straight line all the way across. It's pretty darn straight. we are right back to where we were before the Federal Reserve stepped in and kind of cleaned up this big mess we were seeing in the markets through March of last year. But what's interesting is that rates are currently lower than they were right at the beginning of this. So there's no perfect science. Rates will fluctuate. The science that we all use will not always line up. Like right now, the 10-year Treasury has dipped, but mortgage-backed securities have not. So not all things are perfect. So when you hear the media start saying, oh, the 10-year Treasury is down, that must mean, mortgage rates are down. I wish. It's just not happening the way it's supposed to right now. I hope this has been helpful. If you have questions, comments, concerns, reach out to me anytime. Like I said in the very beginning, if you're buying a house, buy the house. Don't worry about the interest rate. Just get into the house. You can always refinance if rates go down later. And if rates go up, you're very excited about what you have. Thank you so much. I'll talk to you guys soon. Cheers.